All right, team. So this podcast is actually a recent webinar that we did with a Kiwi-based company for free of charge. Now, if you would like us to come into your workplace and talk about financial well-being, reach out via the link below. And remember that this podcast is actually best viewed on video. All right, guys. So thanks everyone for joining. Basically on this webinar, it is the tax changes that you need to know if you are a property investor. And it's not excited that we get, it's not often we get excited about tax changes, but we are pretty bloody excited about this one.
Yep.
So obviously Lighthouse Financial Services, most of you are customers already, but really our mission here is to better Kiwis' financial future, secure your financial future. And we do that for a range of products. We have the property side, the accounting side, with our wealth side that does, investments and insurance. However, fundamentally, we believe that education plus action and a little bit of time equals financial freedom, right? And I'm really excited about talking to this group tonight because you are property investors already, which means you have taken some action to grow your wealth. What we're doing is trying to tweak that to see if we can grow it a little bit more.
Yeah, I agree. And property investors are, well known for taking action.
Yeah.
And I think they're going to really enjoy this because it's been a long time coming, in my opinion.
Yeah, absolutely. Cool. So if we have a quick look at who we are as a firm, we have 4,000 clients across the country. We settled over 900 properties and we have 50 million of funds under management. And I know James will be looking at that 50 million going, I want it tripled by then. Yeah, he'll be like, put a few more zeros behind that. Needs a B next to it.
But, I've got to jump in here. If we looked at the number of property investors that we look after, which be, nearly 2,000, and the value of their portfolios, that number would be significantly higher.
Absolutely.
So we look after a lot.
Yeah.
Yeah.
Cool. So we are going to have to give a disclaimer because we are talking about, pretty specific topics. We are financial advisors and accountants. So we need to let you know that this is not personalized advice. We are just talking in general terms. And look, we're not going to descend too far into the particulars because Lord knows we all need to stay awake. But I think what people are going to get out of tonight is an overview of the changes, how it impacts you, and then basically we'll do Q&A at the end. And I think that's where the gold's going to be.
Yep.
So if you are thinking, I've got a ton of questions, start throwing them in the Q&A section. However, if we get down to really personal questions, i.e. I have this property, this debt, what should I do here? That's personalized advice. We're going to put you wrong. We don't know enough about it just through the chat section. So you will get links sent out and also in the chat at the moment where you can book in and book a personalized call with us.
Yeah, definitely. But certainly I agree with Mike. We're going to run through some stuff, but we encourage questions. It actually ends up providing a heap of value for everyone watching.
Yeah. If you're thinking of the question, it's likely that at least a couple of other people are as well.
Yeah.
Cool. So discussion points. What is on the agenda? So we're going to go back in time. A brief history on interest deductibility. We'll keep it brief. And then the new accounting changes. So what is actually changing and what does it mean for you? And we often find that people learn best by looking through case studies and looking at real life numbers. So we've got a couple of case studies that we'll throw in there as well for two different types of transactions where this would be applicable.
Yep.
Some other things to consider. So we'll look through the lending implications, things around ring fencing, Brightline, all of that sort of stuff as well. And then my favorite bit, the Q&A section, again, just throw the questions in there and we will cover them all off at the end.
Sounds good to me.
Yeah. And you'll notice that I'm doing quite a bit of talking up front. That's because Matt is going to handle the technical piece. But at the moment, let's look at a brief history around interest deductibility, what it is, why it was brought in, kind of what it was meant to achieve, and what are some of the landmark changes.
Yeah, so I think this is a good time for me to start chatting. And I'm so excited. I think the cricket is less exciting, to be honest. So I think, what we're going to discuss here basically is the two parts of the equation here that make a restructure possible again. So if we start with interest deductibility, let's start with Brightline. So a lot of people probably won't be aware that prior to October 2015, there was no Brightline in New Zealand. So we relied solely on the intention-based regime, which was pretty simply, and it still exists, this regime, it's just the Brightline's now a supplement to it, is that your intention when you purchase a property will dictate how it's taxed. Now, that sounds really great, but in reality, it was very difficult for Inland Revenue to police. And because we didn't have a blanket capital gains tax, there's this very wide taxation of land provisions, which are designed to catch property transactions that look like they were done to make money.
Yeah.
all very good. Inland Revenue had a hell of a time trying to police those. And we're thinking, think 2011, which prior to the recent property boom was the biggest property boom New Zealand had ever seen. So the Bright Lines rules came in October 2015. And at that stage, they came in 3 parts. ID numbers for transactions. And I remember when the Bright Line rules came in and not thinking a hell of a lot of it other than this is a good idea. But imagine trying to transact on a property.
Honestly, yeah. The idea of a property transaction having and no associated ID just seems so Wild West.
Doesn't it? No, so you need an ID number for all transactions. You had resident land withholding tax for if you're an offshore seller, and that was stop the leakage of tax. So you had no ID number before, and you didn't have to pay tax if you're offshore because they couldn't find you. And the thing that most people will note it for is it bought in a 2-year period for buying and selling property. And it was a bright line rule in every sense. Line in the sand. 1 year, 364 days, you paid tax. 2 years and 1 day, you didn't pay tax.
And when they brought it in and it was a 2-year kind of rule, what do you think about it? Was that a good? Was it too short, too long? What did you, and what was it specifically trying to stop in terms of like, if we make that, if we make people hold for 2 years before taxing them, what was the intention there?
Yeah, so I thought it was a really good idea. And I maintain that the bright line rules in themselves are a good idea. So what it was designed to do was stop speculation. And it was rampant in New Zealand at that time. 2 years was a great amount of time in my mind, because what it did is it short-term speculation wasn't relevant any longer. Because you
aren't speculating over 2 years.
Exactly. You're taking a huge risk if you are.
And cost.
Correct. But it was long enough. It wasn't so long that it stopped flexibility for people to make decisions with those properties. So, for example, in the latest downturn, there was some investors that were having cash flow issues who would have sold, but they would have been taxed on any sale. So the outcomes, basically, it made any commercial reasons for doing something perverted by a tax outcome, which isn't the way. So that was bright line rules. Fast forward to 2018 in March, they went from 2 years to 5 years. And at that stage, I thought to myself, that's a bit of a problem. What that did is that substantially reduced flexibility for people to restructure their affairs for multiple reasons. And there was no rollover relief.
So that's LTC to trusts, personal, all of that sort of thing.
And there was lots of reasons why those might be commercially viable. So that happened, and then quite by surprise, and this was by surprise, and it feels like a long time ago now, because it was 27 March 2021. The government came out quite unexpectedly, and I say unexpectedly because in the old days they used to consult on exchanges, and there was working papers, and the public was and accounting professionals were allowed to make comments. None of that happened. And they came out and they said, 2 things are going to happen. If you have an in situ property, we're going to phase out interest deductibility. If you buy it after that date, you're going to have no interest deductibility. And you're also going to have a 10-year bright line.
I think in the technical term for that in rugby is a sucker punch. Where they come up from behind.
What is it in cricket? Underarm bolt?
I think so.
So and that happened. But then at the same time, what they created was a 2-tier property tax system, because new builds maintained a 5-year bright line and maintained interest deductibility. So we're going to predominantly focus on in situ properties in this. But you can restructure new builds as well. So this all happened, and property investors were caught quite by surprise. And if you look at interest deductibility history, which goes back further than my involvement in taxation, the general premise when you're running a business, and I firmly believe that property investment is a business like all others, especially if it's undertaken in a professional manner like we like our clients to. The general proposition is that if you incur an expense to derive income, you should be able to deduct that. And interest is no different. If for example, in a trading business, you borrow to buy a piece of machinery,
deduct it.
If you run a cafe and you have to borrow money, you deduct it. If you have a commercial building, you deduct it. So residential property investors really left out in the dark there. So I don't like a 2-tier tax system. Tax systems are meant to be horizontally and vertically equitable. Without boring you to sleep too early, that just means that 2 people in the same situation are treated the same way, and 2 people in a different situation are treated differently. How can you tell me two property investors, one has a new build, one has an in situ, are not in the same situation.
Yeah. So property investors, they've been out in the cold for a while.
They
It was chilly, then it was icy, then it was Baltic. However, things are looking up. There's a bit of sun on the horizon. What are the recent changes?
Yeah, so we're back, baby.
Yeah.
So everyone who follows politics in New Zealand will know that there was a little bit of a political lolly scramble around interest deductibility and bright line rules. All that's happened now, and from 1 July onwards, interest deductibility is back. So it's 80% for the 24 year and 100 onwards. From 124 to 25, and then hundreds from 125 to 26. And the bright line rule is back to 2 years for all properties. So this is really great news. The bright line rule is something that will play a part in restructures, and we'll get to that in a minute. And I think just from an outcome perspective, if you're a property investor in New Zealand, you probably have felt quite aggrieved over the last few years. Property investors provide
beat enough.
Correct. We provide accommodation at a lower cost than the government, and the myth that it's a myth that landlords are greedy, bad people who don't treat their tenants right, because I tell you, you and I both know from our client base that it's not the case.
Absolutely.
So that's a brief history of deductibility. That wasn't that brief.
No, it's so I guess in terms of why does this matter and what does it mean for you? The two changes that have recently come in have meant that actually we can restructure private debt and it can help your financial position. We'll go through two case studies now, but really what we're looking at doing here is changing the debt and the ownership of the debt and the property from one entity, maybe personal names, to another entity, maybe a look-through company or something similar, to maximize the tax benefits available for you. Now, that is as close as I will stray to giving tax advice on a recorded call. So, Matthew, help me out.
Yeah, I'm going to help you out on the examples. And at the end, because these examples are just blanket examples, at the end, I'm going to explain a little bit about the rules, the fish hooks, and why we can do it again. But I think let's get the examples into people's heads.
Yeah, cool.
Yeah. Upgrading your home. So this is a very common situation that we see. So Ben and Bella have owned their home since 2017. They've worked really hard to pay their mortgage off. They originally purchased that property at for $500,000, but it's now worth $800,000. They live in it for now. They decide that they want to go buy a new property, and this is pretty common in New Zealand. People to upgrade their home, leave an old property behind as an investment, and keep moving forward.
Yeah, if we can, we will advise our customers to do that, because we aren't a fan of selling assets. We want to try and hold on to them because it ain't never going to be cheaper than the moment you bought it. So yeah, this is very common.
Yeah, and we at Lighthouse, we believe compounding returns the most powerful force in the financial universe. And with property, unless it's a terrible proposition, then there are reasons why it could be, it's a lot easier to maintain that asset and hold on to it than it is to go buy a new one.
Absolutely.
So they go and buy a new house. $1.4 million is the purchase price, and they have to borrow $600,000 to fund that investment. So in case it's not already clear, if the situation as it is, their former owner-occupied property would not be a very good, well, it would be a great rental, but from a tax perspective, the outcome wouldn't be good because there's no mortgage.
Yeah.
So in this example, they'll rent out the old house for $700 per week, which is about $36,000 a year. They have a whole lot of holding costs, rates, insurance, repairs and maintenance, which are pretty common to all investments.
Yep.
And based on these calculations, about a $29,000 per annum profit. And you'll see there that there's no interest deduction holding costs, and that's because they've got no mortgage. However, they will be paying interest at 7% on the $600,000, which is on their own occupied house, which is about $42K a year.
Yep.
So in this example, without a debt restructure, they will pay a tax bill estimated of $9,700. What we're now allowed to do again is take that former own-occupied house and push that into a new entity. So the reasons that we do that have to be commercial. So we can't just restructure everything. There's got to be sound commerciality about it. So if I'm a property investor and I am embarking on a wealth creation journey, there's some things that would be desirable to me. Separate legal entity, which an LTC provides. Limited liability, which an LTC provides. And professionalism, which an LTC provides. So those in itself are the general reason to move the property. the Tax Act doesn't specifically say that you can't seek, you can't get tax advantages out of commercial outcomes.
Yeah.
So if we go to the next slide, this is how it works. The LTC will borrow the $600,000 from the bank. So we'll shift in that property at its $800,000 value. And we will borrow the $600,000, and that will then sit with that LTC in the company structure. The outcome of this is that your new home now has no mortgage. So that's a totally commercial transaction. The LTC will have a new 2-year Brightline. So this is something to remember. If your property is in Brightline, which will be the case for some, but just remembering if you were in a 5-year or a 10-year Brightline, as long as you've held that property for 2 years, by 1 July, the latest changes, you are outside Brightline. If you're inside Brightline, then we probably won't be looking at this because rollover relief won't apply because of the way that brings the property in.
And I think that's a really important point just to highlight there is this is going to be suitable for some customers and it's not going to be suitable for others. And there's a myriad of reasons why it would or wouldn't be suitable. And I think that's why it's really important that if you're thinking about this, to book in and have a quick chat with some of the team, probably Matt, just to actually think, okay, is the juice worth the squeeze here? Are we missing something before we go gung-ho and start opening up LTCs?
Yeah, correct. And at the end, we'll go through some of the other things that are going on. So the outcome of this is that the look-through company gets a tax deduction for the lending, 80% in the current year, but moving to 100%. And what has happened in your tax, if you can see from the example, we have residential ring fencing, which means you cannot offset rental property profits against anything other than property.
Surprising how often I get surprised how often I get asked that.
Me too, actually. Even after all these years, ring fencing's been around a long time. So anyone watching, you can't offset rental property losses against your income, but that loss is ring fenced in your own names flowing through from the LTC. It does carry forward to offset against other future property profits. But the outcome of this is that you've ended up with the same 2 properties, the same amount of mortgage, but your tax bill has been reduced by $12,600. So you see that's a pretty good outcome.
Absolutely.
Yeah.
And that's year 1, right?
That's year 1.
Yeah.
So we'll talk about some of the costs of getting this done at the end, but you can see that there's an outcome there. That's a reasonable amount of debt, possibly not the case for everyone.
No.
But it was a good example. Thanks, Robbie.
Cool. So our second case study is around refinancing your investment property. And again, something we see quite commonly. And I guess from my perspective, this is probably more common than the first one, especially at the moment as the rules have just kind of changed to allow this. And we've got a lot of people interested in specifically this. Yeah,
definitely. And this might look like the same example, but it's not.
The untrained eye.
Yeah, exactly. If you aren't living and breathing tax, you can't get this. But the previous one was really specific to upgrading your house. This is something we see all the time, and honestly, I see this in lots of different ways. So there's people that have joint properties, individual LTCs. We're going to keep it simple here. So Ben and Bella have decided that their life story has changed, and they now own an occupied home and rental. Both are valued at $1 million with $500,000 mortgage each. Both properties outside the Brightline. They can claim currently the deductions on the $500,000 that pertain to the income earning asset. And just remember that now that we're back in the real world, when you incur $1 of cost to derive income, then you get to deduct it. So that's where we're at. What we do here is a very similar restructure, is they would take that rental property, set up a new LTC and sell it in at its market value, which is $1 million. I think you can see the outcome. What we're going to do is a little debt reshuffle. We're going to take the debt off the owner-occupied property and put it onto the investment. Again, we end up in the exact same position. Same 2 properties, same amount of debt. It's just where it sits that differs. And likely the same commercial rationale for doing this would exist. So you can see here that if we have simply moved the debt from the owner-occupied house to the investment, $500,000 of debt at 7% becomes deductible, which is about $11,500 in tax.
So again, a pretty good outcome for the customers, especially in year one.
Yeah, definitely.
And especially considering that this will be ongoing.
Yeah.
Oh, well, we pray that no one comes in and changes it again.
Yes.
But again, there is a lot of reasons. One, why to shift into an LTC, around the professionalism, around the separate entity, and the limited liability. But again, it can also provide some tax benefits off the back of that.
Correct. And I think it's important. These are obviously pretty bullish examples. We wouldn't necessarily do this if you were only making losses.
Yeah.
There's got to be some tangible outcomes here, but it's important to get it right because, as you say, interest deductibility is likely to stick around for many more years to come now. So I think what we'll do now is, so here's some things to consider, right? So Brightline, obviously, we've already mentioned that 2 years. If you are still inside Brightline, that we would definitely be considering, we would definitely be waiting.
Yeah.
As soon as Brightline is an issue, we stop any chat about this. We can revisit it later.
And this might be a silly question, but I'm not a tax man. Would this restart any Brightline periods?
Yes, this definitely restarts Brightline. So if you do a restructure, it will reset Brightline for 2 years, but it does it at market value.
Yeah, cool.
So it does it at the transfer value. So first of all, if you're thinking of selling in the next 2 years, don't come about a debt restructure.
Yeah.
You're going to incur yourself costs and time, and you're going to.
And ultimately, you have Brightline on the back of it.
Correct, which would be like kicking an own goal.
Yeah.
So don't do that. But what if you are certain or reasonably certain, 2 years isn't very long, reset at market value. So in those examples, $1 million. If you sell in 1.5 years and it's gone up $50,000, then you wear tax on a little amount.
Yeah, not from the original purchase.
Correct. Correct. Interest deductibility rules, well, obviously they have been brought back in. So what's actually happened, to give people some context, is Part DH, which is the part of the Income Tax Act where interest deductibility was limited, has been repealed. And not quite in totality, but for the most part. So rather than being new rules, we're actually going back to the old rules, which used to allow this. And to give you, I'll get to it shortly. Number 3, ring fencing. Property losses can only be offset against property income. As Mike said, we get this all the time. People still asking for their refunds. Unfortunately, those days are long gone and unlikely to return.
Is that different to Australia? In Australia, are they ring fenced, or are you able to apply? Do you know?
I can't recall it.
Yeah,
I think you used to be able to apply. Yeah, I'm pretty sure they've cut it out as well.
Yeah, I was talking to someone based in Australia the other day, and I'm pretty sure what they were saying to me is they can just offset it against anything. I was like, oh, it doesn't sound right, but I don't know what you're talking about.
Although Australia has quite a different tax system.
It is fair, yeah.
They have capital gains tax. They are allowed to deduct things against their personal income, which New Zealanders aren't really. Number 4, conveyancing. This is a big one. This is likely to be the largest cost that you'll face as part of a transaction. So that's for those who the term's not familiar, but you should be because you're property investors. That's the transfer of the titles and the documentation of the remortgaging.
Yeah, and with this, we can give recommendations around solicitors that we can kind of work with, and we know provide fixed fees for these sorts of transactions because, it will start to become quite a common thing. And we've already seen some solicitors around the conveyancing for refinances and transfers give fixed fees. So feel free to reach out if you're looking for a solicitor to undertake that.
Yeah, definitely. And they do seem to have really high fees, like inflation legal fees a lot. We love you lawyers. We work with you a lot, but they definitely have high fees.
Yeah.
Mike, you probably do lending rules.
Yeah. So I've got a slide on lending rules, but there are definitely some considerations around the lending. It is not as easy as just we're going to mirror a loan from here to here and it's all good and keep going. You do actually have to get into the weeds a little bit with the banks. I'll cover that off in a separate slide.
Okay. And so number 6, avoidance, a very scary word. To be frank, we are not interested in any way at all in helping our clients avoid or evade tax.
Nope.
What we are interested in doing is minimizing the tax they pay within the law. We're also really interested in commercial outcomes and protecting assets and growing their wealth for long term.
Yeah.
So this is definitely a step in the right direction. For those who are concerned, first of all, it's very specific to your situation, but in their revenue many years back issued questions we've been asked. I think it was QB 1211. That actually outlines the very debt restructure that we have shown in this webinar.
Yeah.
And it says that it confirms that it's not tax avoidance, that taxpayers are able to restructure debt in a way to maximize outcomes as long as there's commerciality in it.
Yeah.
we will always approach every restructure carefully and provide the advice that's required so that people don't get any trouble here.
Yeah, absolutely. And I think it is really important, is one of our key things at Lighthouse around growing your wealth is if you're growing your wealth, sometimes you're just going to have to pay tax. It's kind of a good thing because it means you're making some money. Obviously, we don't want to pay too much. However, fundamentally, we are always looking at the plan that we're implementing and how is that going to grow your wealth. And this should be part of it.
Yeah, that's right. I think every taxpayer has the right to minimize the amount of tax they pay within the law. So we're just interested in helping our investors get ahead. And there's been a long period of high interest rates, and a long period where interest hasn't been deductible and or debt's been in the wrong place. And in the pre-2021, we would have just restructured and move on. And this work was very common. So anyway, obviously, if you decide to pursue this, you can have a talk to us about your concerns. So what wouldn't work? And this is just one example. There's many examples that won't work. Ben and Bella, they own an existing rental. It's debt-free. That is owned in a trust structure. Trusts are really common structures in New Zealand, 1 for every 13 New Zealanders, according to the data that came out in the new Trust Act a few years back in 2019. So a lot of trusts in use, really good asset-owning vehicles, provide professionalism, liability protection, and flexibility. So they're in wide use. They've got their home, which has an 800K mortgage. That is also in the trust. In this case, the existing rentals outside the trust and the existing homes in the trust. In this case, they want to sell the rental to the trust. The trust borrows 800K to repay that private mortgage. Both properties are owned with the trust with interest deductible against the rental. What this does is allows Inlay Revenue to raise an argument that the interest retains its private and domestic nature, and the real use of the funds was to refinance a private loan. So you can see, if you look on the right-hand side here, the funds are circular, and that would be an indication that the transaction is not as commercial as it could be. And this is what might open you up to some trouble. So you can see the bank lends 800K to the trust pays 800K to Ben and Bella lend it back to the trust. And then the trust then pays 800K loan off the bank. This all happens in one go. Doesn't look good.
Exactly. So this is the type of thing that when we are assessing a situation, we would point out and say, hey, it's not going to work here. Let's look at something else. Yeah,
definitely. And as we said before, we're not interested in anything that's going to get anyone in any trouble. And this is something that might. So there's an example of what might not work. But again, book in for a chat if you want to explore this.
Cool. All right. The juicy stuff, the lending considerations. Now, we are getting through the webinar, so I can see some Q&A, some questions in the Q&A function already. Make sure you keep throwing them in there. Matt and I will stick around for as long as you want and keep asking questions, answering questions. But here are some things to consider on the mortgage side. So when this first came out, we were talking around the how we were going to do this, what the function and the mechanism was inside the lending and the bank to make it work. I was thinking, oh, look, we can just mirror a loan. And mirroring a loan is super simple, right? Same account, same interest rate, same amount, same repayment schedule. You're just changing the owner. And if there's no beneficial owner on there, no problem at all. It's basically just a name change on a loan. Very simple. Unfortunately, that isn't going to work. We do need one loan to pay out another loan, to fully pay it off so that you can see that it has been sold from one entity to another. Now, this may incur interest rate changes. So for those lucky few of you who are still on 3-point-something%, Ravi's got his hand up. Thanks, mate.
You deserve that.
But for those of you who are still on those low interest rates, there may be a situation where actually you're going to go onto you will go onto a higher interest rate. There's not a lot of people that are still on those really, really low rates. So
if they're out there, we know about it because they tell us.
So there may be a scenario where actually the interest rate changes mean you'll just probably wait a little bit longer until you're about to roll off, but it's not very common in most cases at the moment. Property valuations. So if you are going to sell debt, and you only get one shot at this, I believe, thereabouts.
Yeah, I mean, it's strictly not one shot, but you would have to wait a long time to get another go at it.
Yeah, before it was a commercial reason again.
Yes, correct.
If you are doing this, you want to maximize the amount of debt that you can shift into the new structure and against the investment property. It will be worth then, in some instances, getting a valuation on that investment property to increase the valuation, right? That can run anywhere from inflation, you guys would say $900, probably nothing less than $1,000 these days. It's probably looking at 1,000 to 1,200 for that property valuation. However, it can give you an uplift, and you got to remember, year one, yep, you might have eaten into it a bit of cost for the transaction, but year 2, 3, 4, 5,
ongoing,
it's going to pay itself back.
And this comes back to getting it right and having the commercial basis to do this.
Yeah, absolutely.
Without it being criticized.
Yeah. Situation changes. So when you buy an investment property, generally speaking, you're in pretty good shape. The bank's going to give you the loan. You're feeling confident enough to take the risk on the investment, and you know it's a long-term thing. So you've had to do some sort of risk assessment, at least in your head, if not vocally.
So James, before we continue, I have got a special announcement.
Have you started sticking to your budget?
Absolutely not.
You finally made it as an after-hours DJ.
I wish. Mate, the thing is, we have got a brand new podcast partner, Partners Life.
You mean the award-winning insurance provider with over 300,000 Kiwis insured?
Yep, they're also a New Zealand operated company, and they are passionate about increasing financial literacy amongst Kiwis.
Sounds like a great match. Where can I learn more about them?
Check out their website in our show notes below.
Really thought DJ Magic Mike was going to be a global sensation for a second.
Often over time, as these are long-term assets, people's situation changes. So someone might go, oh, we bought this 10 years ago and both of us were working, Matt, but then you got a little bit lazy and you wanted to work 3 days a week, and I had to keep working, and then I didn't want to.
I thought you were going to say,
so I changed jobs, and your situation might not be the same. And you've got to remember that over that 10-year period, it is likely that lending and taking out loans has gotten pretty hard, given some rule changes. So we need to make sure that the affordability assessment is still there before we actually go to the bank and do it. Because it will be a full application where we have to reapply for the loans. So it's not as easy as just mirroring a loan anymore. No. So if your situation has changed dramatically, have a chat to Matt first, and come have a chat to us in the mortgage team, and we can just make sure we can do it for you.
I think it's an important point when the few conversations I've had about this. Basically, if it looks like it works, the very next step is to go to talk to the mortgage broker, because it starts and ends with a mortgage approval. If you can't do that, you can't do anything.
Exactly. And a lot of the times in the mortgage team, we are very picky or specific about situations that we will approach the bank for when people have existing lending. We don't want to open a can of worms with anyone if there's not an outcome on the end of it, right? So we will not just absolutely whole shot everything to the bank and pray that, it all goes ahead. We want to make sure that there's some outcome there, because we don't want everyone going through all your transactions and you go through all this work unless we're going to do it. Next one, split banking. So sometimes, for the longest time now, we've actually been advising customers that they should split their banking out to different banks. Have your owner occupied here, one investment property here, another one here, and just to try and protect, the proceeds of the fund when you sell. It can maximize the amount of properties that you can buy and your borrowing ability. There's a lot of reasons why we recommend split banking. That can make things a little bit harder when we're looking at this. However, I don't think we will need to move everything to the same bank. We can still achieve the same outcome by using, still using split banking by using guarantees. So let's say I had my owner-occupied property at Westpac, my investment property at ANZ, and my Westpac property I sold into the LTC. I have, 500K of debt on there. I shifted 200 TC, and I needed 300,000 to remain in my personal name. We would put a guarantee from the look-through company at Westpac in favor of the personal borrower, so that you could keep that 300,000 in your personal name. So again, you can still hit all the rules and all the targets and get yourself there, but it's just going to be a little bit more complex. And if we're putting a guarantee in place, sometimes that will require a solicitor to review the guarantee and explain it to you before you can sign it off, because it is a guarantee. It's a legal thing. Some banks don't do it. Most banks do. But again, it might just be an extra additional cost on top of that conveyancing fee from the solicitor, because boy, do they know how to charge. Long-term plan. So again, we kind of talked about this a little bit earlier. Paying tax, if you are growing your wealth, at some point, you've just got to do it. We are not going to do this if this jeopardizes your long-term plan. Like if you come to me and say, Mike, I want to get 3 more properties, I want to do this, I want to do this. And I go, yeah, cool. But if we do this now, shifting the debt over here is going to freeze up some borrowing capacity. I want you to think about what is more important, an $11,000 savings or more or less for you, or we get, another property, wait a couple of years and then do it. So again, I emphasize with all of my customers, they need to have a long-term financial plan in place. And obviously, I'm biased, but we do them here. They're pretty good. We all sit in the same big room. It means we can talk to each other and make sure you get a good outcome over the lifetime of your finances.
Yeah, and for anyone who hasn't considered a financial plan, doesn't know what it is, they are literally looking into the future.
Yeah.
You sit in a room with the wealth team, they take the assets that you have, they take the cash flows that they have, they extrapolate those out to the future. So if you do nothing, you see the outcome.
Yeah.
And then the magic starts. And this is the hard bit, actually. It's the questions that get wrapped around it and the assumptions. And, what do you want to achieve? When do you want to retire? All these things are questions that can be answered now in a complex financial world, where you can't just rely on a gut feeling anymore, where the environment's changing really quickly. And all I'd say on this point is they're worth their weight in gold. If you want to know more about one, you can have a 10-minute chat with one of our wealth team, and they can answer your questions. There's absolutely no obligation for that, but seriously, I can't underestimate this. They change people's lives.
Yeah, absolutely.
Yeah, and that's from coming from someone who just does stuff.
Just to do it.
Just to do it, buys property and went along the journey. That journey is so much harder now. So I would encourage people, if they're interested in that, and taking that up.
All right. Well, okay. So we're getting to near the end of the session. So I can see some questions again in that Q&A section. Give Matt a break on the questions. If you want to ask me where I think interest rates are going to be today, tomorrow, the next day, by the end of the year, and it's recorded, so maybe you can hold me to it, feel free to do that as well. Guys, we have a weekly podcast, which we love filming. Like I said at the very top of today's webinar, the last one we did was yesterday with Jared Kerr, Chief Economist of Kiwi Bank. Some super insightful stuff in there, not just for property investors, but for business owners, for people living in New Zealand, for people thinking about buying property. We covered a whole range of topics, the share market, why the NZX50 sucks, why everyone else is so good, whether or not we should scrap the official cash rate and use KiwiSaver to take money out of people's pockets or put it into people's pockets as a minimum contribution level. So I was very excited because that was my idea and he said it was good. But we do the weekly podcast either week. They're a ton of fun. You can get them on Spotify, YouTube, Apple Podcasts, most places you get them.
You're still not going to be able to call yourself an economist.
I'm not.
Awesome. Cool. Shall we crack into it?
All right, so I will run the Q&A section because Matt will be answering them all. So first question from Francis. If you do intend to sell for a profit, how does Brightline work?
In the context of a debt restructure, you just simply wouldn't do that.
Yeah.
Because you're selling from yourself to yourself and you'd be creating a tax bill, which, I mean,
it's an own goal.
I'd like to. It's another own goal. I'd like to say no accountant in New Zealand would advise that, but I don't think that might be true. But we definitely wouldn't let you do that.
Yeah.
If you do trigger Brightline and sell at a profit, then you will pay tax on the net gain. So you don't pay tax in totality. You pay on the sale price less the purchase price less a whole lot of costs.
Yeah. And then I think the second piece we were talking about, the Brightline and the timing, because I'm not sure when this question was asked in the webinar, was if you are considering selling in the next couple of years, it may not be appropriate for you to do this restructuring now because you may trigger Brightline. What about GST with a look-through company?
Yeah, so GST is not specific to any structure. So GST is a goods and services tax. It's on pretty much everything in New Zealand with the exception of interest and some other financial services. When it comes to residential property, GST is exempt. So the general premise is that the government doesn't want to levy GST on residential rents because it would drive them up, which is pretty fair. And for people who don't know, New Zealand's GST regime is actually one of the least complicated value-added tax regimes in the world. Not many exemptions, but property's out of it. So GST would only be an issue if you had a short-term rental. In that case, you would already likely have it in a GST registered entity. You would transfer it to a new GST registered entity. So maybe it's a jointly held or individually GST registered. You would have to register your look-through company. It might even be that a closed company would be more appropriate for GST and it would be zero rated through. I don't think we're going to see this very much or at all. So I wouldn't worry too much about GST, but again, specific advice for your specific situation would be required.
Yeah, absolutely. Matt, you can ask me this one because it's a mortgage question. I'm excited.
So, you mortgage broker. Mike, what happens to existing mortgages if restructuring to an LTC?
Cool. So like I sort of said a little bit earlier, we can't just mirror the loans. If we were able to mirror the loans, like it was just an ownership change and there was no, you weren't actually looking to restructure the debt for a favorable tax outcome, we can basically nothing happens to them, right? It is a mirror. We just change the title on the top of the loan and you keep on paying. Because we can't do that, they are new loans that will pay out the old loans. They will be on new terms. We will have to agree on those terms as part of the mortgage application with the bank. So, there may be a favorable thing here. Can we kick the loan term back out to 30 years?
Yep.
Because we're applying.
Yep.
If you're, if you had a 5-year interest only period and you're winding down to 4 years, well, we'd reapply for another 5-year interest only period. So they are brand new loans. They'll be at new interest rates. They'll have new terms. We can apply for new interest only periods at the same time. TSB recently brought out a 10-year interest only period. So for everyone who's at TSB or wants to think about TSB, that's quite a positive thing. So yeah, look, new loans, new rates. So basically, they're going to be on new terms. The only caveat there is if I'm breaking one big loan up and you're only, let's say you've got $1 million loan and you only want to shift over 600,000, I can do a partial break on that loan.
Yep.
Which means that I can break off 600 and the remaining 400 will be on those original loan terms. So you wouldn't lose your interest rate on that original loan term. You wouldn't lose any of the other terms, repayment amounts, etc.
Yeah, and I think it's really important to note that the commerciality aspect of it requires a new loan.
Yeah.
And so you should be expecting that the loan structure is going to change, probably the rate will change. But inside that, there is probably outcomes like cashbacks and interest only periods, etc. So talk with your mortgage broker.
Yeah, absolutely.
Yeah.
Cool. In scenario 2, would you do the same approach and use an LTC if both properties were in a trust?
Yeah, so this one's a little difficult, Lisa, because the commercial rationale moving from an LTC to a trust would be quite strong. Matrimonial relationship, property protection, inheritance, higher level of asset protection if you're a business owner, for example. Moving from a trust out to an LTC probably doesn't have the same commerciality. So my short answer is we'd probably have to consider the situation in which this arises.
Yeah.
But my initial thoughts is that probably is going to be less cautious than the other ways that we could do it.
Cool. Next question from Jeremy. For married couples, are look-through companies associated to just one person or to the couple? Assuming it's just one person and probably beneficial to be with one partner if they have a lower income. And are there any pros, cons around how you would set it up? What are the general pros and cons of a look-through company?
Yeah, big question, Jeremy. Thanks for that. Let's go home sometime tonight. Maybe stay the night. No, kidding. Good question. So LTCs are associated to whoever's the directors and shareholders.
Yeah.
So it can be one person. It can be multiple. Generally with couples, it's both. To be beneficial. So to be clear, look-through companies provide separate legal entity, liability protection, and professionalism. They can provide tax outcomes. So a look-through company is an ordinary closed company with a tax election, which makes it transparent. That's a pretty fancy way of saying profits and losses flow out to the individuals.
Yep.
So if you have a positive yield property, for example, and you've got one earner who's a high earner, maybe 39%, and you've got one who's a lower earner, maybe 17.5%. I'm using old currency too, I've just realized, in tax rates. The advantage you could have gained from an LTC is set the shareholding to stagger it more towards the lower earner to get a tax outcome. So that's one pro. Cons around them is they are not flexible in any way at all. A change in shareholding is a dispersion and acquisition of the underlying assets. So basically a bright line issue share property. So when you set them up, it's a 2-year period before you can do anything. So that's one of the cons. There's lots of other pros and cons, not the place to go through them. But in short, LTCs are widely used in New Zealand, widely understood by banks, mortgage brokers, accountants, and they are a very good entity because they are very close to a partnership. In the way that they function, but they have that added layer of liability protection professionalism, which in the old days, you might argue you didn't need so much, but the liability for property investors has been increasing for years.
Yeah, absolutely.
What do we got? Healthy homes?
Yeah. Healthy home.
Meth testing?
Yeah.
You know, imagine a scenario where your tenant burns down the house, but they don't just burn down your house, they burn down the neighbor's house. So there's lots of places where risk is becoming more apparent in property. And I just look and I go, if you're a commercial businessman and we're property investors, we are.
Yeah.
If I could have a structure with limited liability, or I could be an individual owner with unlimited liability, which structure would I choose?
LTC every day.
Yeah, correct.
Cool. How are the costs on maintaining the LTC? Are they nominal when compared to the first example? So I think the first example, there was about 12,000 of savings, was it?
Yeah, so they are nominal. Companies do have a higher threshold when it comes to preparation of financial statements, for example, which are mandatory if you earn over 30,000 in a company. They also have a company's office annual return. But to be honest, the difference between a jointly owned return and an LTC return, I would budget about $600 a year plus GST is the difference in accounting costs if you work with us.
Cool. Are there minimum deposit requirements or usable equity limits with the bank when borrowing for an LTC? Yes, there are. So if you have negative equity, we basically can't touch anything. It doesn't matter if we are changing amounts, properties, if everything is staying exactly the same. Unfortunately, the bank won't go near it. And I would highly advise you not to try that with the bank, because what will happen is they will look to reprice the loans with a low equity margin or a low equity premium the next time that you go to refix. And that was to my point before about we're not just going to go to the bank blindly and scattershot something to see if it's going to work, because there may be outcomes or unintended consequences for your situation if we do that. So generally speaking, you're going to need the minimum amount of equity for your situation, right? So if that is a new build property, it might be different to an in situ property. But basically, if you don't have the required equity there, you could be in a little bit of trouble. So again, have a chat to the tax team, then have a chat to a mortgage broker. We can value the properties on the same tools that the banks use. We can run all the numbers for you and let you know if you've got the available equity to shift stuff around. You don't usually need to tip in kind of more deposit or to shift assets around to give you the available equity if you already have it, though, because we can do that again, like I said, with split banking and guarantees in place. So short answer, which I've just dragged out, is you got to have the minimum amount of equity. And if you don't go near the bank because they'll reprice your loans on a higher interest rate.
Yeah. So in short, speak to a mortgage broker, use a mortgage broker, don't go to the bank.
Also, would there be any other incremental costs such as increased insurance or rates? No, this isn't usually an event that would trigger a refresh in the insurance. You would have to change the ownership of the policy because the ownership of the property has changed, but it wouldn't usually mean that you have to re-trigger the insurance. Some banks may ask you to re-quote the insurance in very specific situations around this. If they look at the property value, like let's say you insured it, let's say you own the property for 20, 30 years, and you took the insurance out at the start and you haven't changed insurance, they will likely look at the value of the property now, look at the value of the insurance and go, I know that you're only insuring the house and not the land, and the land is what is fluctuating, but I still want you to go out and increase the insurance premium on this. So again, it'd be very specific situations. It's not going to affect your rates at all.
Yeah, and I think really important point you've just made that some people still don't realize in New Zealand is that we have a cost to rebuild basis for insurance policies now, and the ones I see are woefully underinsured. We're in this perverse sort of epoch in New Zealand where if your house burns down, you can't rebuild it for the same money it costs you to go buy it on the open market if it was available. So if you haven't reviewed your cost to rebuild insurance in a while, go have a look at it because you might find it needs a couple $100,000.
That's a great shout, actually. Cool. Anonymous attendee, if you don't set up a look-through company and rental or an owner-occupied are under one name, can you still use the interest deductibility? So basically we're saying if it's all owned under your owner-occupier on personal name, is there a way you can still use the interest deductibility?
Only if it's been delineated in the beginning to start with, and you cannot increase the amount of debt.
I have no idea what that means.
Yeah, well, they mean delineated, like split, like when you drew down the mortgage, even though it's all in the same name, 500 was for the rental, 500 was for your property. That causes a real problem. We see this a bit. My immediate answer is we need to know the details. If you can't pin the debt against the property, then you can't have the deduction. That's simply because the rules are pretty clear. They say the use of the funds dictate the deductibility. You can't show a clear use of funds, you can't have it.
Yeah, and that's on our mortgage side as well, we always give customers the advice that they should split the loans. Even if we're fixing the same for 6 months, split them out. You never know when you're going to need it later down the track. And yeah, it's one more account on your internet banking. It's the same if you're doing a dollar for dollar refinance. You need to be able to pinpoint the debt straight to the property.
Yeah, and I never understand why people don't do that.
I know.
Do you not want to know?
Yeah. Cool. What sort of equity are the banks looking across the total properties and loans? At the moment, it is 30% for a in situ or existing investment property. You can go as low as 10% in some instances with a new build property, but it's again one bank, and they will absolutely ping you through the roof for the interest. Second tier lenders will do it as well, but generally speaking, 20% or 10% for new build properties, 30% for in situ properties. There are specialist lenders who will do more. Again, though, you're going to pay for that privilege. Cool. Say you have 500K of usable equity. Oh, this sounds like quick maths. In an owner occupier and are wanting to buy a multi-unit block. Best advice for structuring and considerations.
In the interest of keeping the questions going, we don't know if it's positive yield or negative yield. We also don't know if there's other people in your family group who work or don't work. Multi-units quite often are positive yield.
Quite often they're commercial as well, depending on the size of the multi-units.
So trust, look through company or close company.
And that's actually a really good example of when there isn't enough information on the web that we can kind of gather here. Even if you fired all that through, we probably still couldn't do it accurately, so we won't. Of when you should just book in and speak to us, because this sounds like if you're looking at buying a multi-unit block, one, there are a ton of funding considerations you have to think about that. You may not have realized that in some banks, it will be commercial lending. At other banks, depending on the amount of units, if it's on one title or multi-titles, it may be residential lending. Also the tax implications as well. So again, book in with us. Happy to run through that, Paul. Cool. One from Ian. Hi, what if you have a rental in a trust, was a family home, 35K on the mortgage, and you've purchased a new family home with over 700K of mortgage? New family home not in a trust.
That looks like it could be a good candidate for a restructure because you've got it the wrong way around. Your family home should be in the trust. There's good asset protection and estate planning benefits to do that. Your investment property could come out and be in an LTC or could stay in the trust because there's still good reasons to have that in there. So Ian, probably, I would get in touch about that one. We can have a chat.
Yep, cool. Last question from Charles. When restructuring to different banks and selling to a different entity, I've got some in there as well. When restructuring to different banks and selling to a different entity, do banks offer cashbacks? If you've got a good mortgage broker, they absolutely do. If you go straight to them, they'll be like, oh, it's just a restructure. We don't pay on this. Look, hey, so it is a payout. So there is the opportunity to get a cash contribution from the bank. Probably worth noting, though, it may just be covering your old cash contribution if you're still inside that clawback period. So, have a chat to your broker. We can run through all the costs there.
Yeah, cool. So we'll jump in these. So there's a good one there from, so let's go start at the top. Thanks for the dig, Emma. The IRD lives on. Jeff Young had a good one. How come your examples aren't looking to make use of the rollover relief? That's because, Jeff, the new rollover relief rules, which are not too different to the old rollover relief rules, which were a dog's breakfast, require properties to be transferred at cost. If you're transferring at cost, then the debt arbitrage that we've just talked about in this whole presentation doesn't exist. So that's why, apart from the fact that the rules are really bad.
Cool. What's here? What's the difference between an offset and a revolving credit? What one is good? An offset, a revolving credit account is a giant overdraft at a home loan interest rate. So instead of having an overdraft of $10,000 or $5,000, like your personal one, it can be 100, 200, 500, $1 million. We did one for a customer the other day of about $3 million. Very specific reason for that. So it is just a giant kind of overdraft that you can pay off and kind of pull money back out of again as you need it. An offset account is two accounts, not one. So you have the loan and you have a savings account. And all you're doing is putting money in the savings account, and it will stop you paying interest to that amount on your loan. So if you've got $100,000 of debt in your offset facility and you've got a savings account with $60,000 in it, you will only pay the difference on $40,000, which is the difference between that savings and the offset limit there. So I guess in terms of which one is good, from a lending perspective, they both achieve the same outcome. One is a transactional account, so we'll have higher fees and a higher interest rate. One is a savings account and a more standard loan. So at BNZ, you can usually fix these. They're not on floating rates. So again, there's a ton of different advantages for each one. You can link multiple savings accounts to an offset facility. So let's say you have some parents that want to chuck you some money or something, they can sit it in that savings account or stop you paying interest on the loan. From a tax perspective, though, I probably can't answer that.
I'll answer that one because it is quite different. If it's up to me, offset accounts all day long.
Yep.
And the reason being that it's two different accounts. You have your loan, 100 grand, your offset account, 100 grand. You can go in and out of this one as much as you like. Your loan does not change.
Yeah.
Revolving credits, you got to be really careful for tax purposes because that 100 grand, there's not one account.
Yeah.
You're dipping in, dipping out, dipping in, dipping out.
What's the purpose of the funds?
Yeah, correct. 100% correct, Mike. You should come join the accountants.
No doubt, mate. Yeah.
You're recharacterizing your loan.
Yeah.
And depending on how much and how big those swings are, you can literally do away with the deductibility on those loans.
Yeah.
So revolving credits, not saying don't use them. Plenty of people use them and don't touch them. Or if they do touch them, it's related and deductible because it's property.
Yeah.
They bought another property, for example. But yeah, just be careful and talk to your mortgage broker, talk to your accountant.
Yeah, absolutely.
Yeah.
Cool. I
Might
think
be us.
that is it.
Everyone must be asleep.
Cool. We got there. All right, guys. So thanks for joining. Obviously, we tried to give as much as we could without descending into the particulars too much. There were some great questions, which we always love, which means that there is probably a ton of reason for people to book in and speak to us. Start with Matt, have a chat to Matt, see if the debt restructuring is going to work for you. And then you can come have a chat to us on the mortgage side to see if we can get it to work. Otherwise, Matt, thanks for a great hour.
Hey, thank you for joining me today.
No problem.
This is my podcast.
Cool. Thanks, guys.
Thank you.